Hey everyone, Johan Videos here, and I'm going to say something that is going to make a few people uneasy. If the monetary system is cracking the way it looks like it's cracking, then the question, when do I sell my gold and silver, might be the wrong question. Because if you're asking that right now, you might be standing on the deck of a ship that's already taking on water, and you're negotiating what you'll accept for the lifeboat. Before we go further, quick, honest favor, my analytics still show most people watching aren't subscribed. If you're getting value from this, hit subscribe and drop Johan Videos in the comments, so I know you really here with me. All right, let's get into it. Overnight, we watched gold press back toward the high 4800s again, and silver hovering right around that mid to high 90s zone. And I know exactly what that does to the brain. It flips on that voice that says, this is the top, take profits. Lock it in, don't ride this thing all the way back down. And look, that voice isn't insane, it's conditioned. It's trained by decades of fiat thinking. Trained by decades of charts priced in currencies that quietly lose purchasing power. Trained by sell the rip advice from people who talk like the system is permanent and the measuring stick never changes. But here's the cliffhanger I want you to sit with. What if the thing you're pricing your metals against is the thing that's failing? What if the goal isn't cash out into paper, but to carry real money into the next chapter, and then to swap that real money for real assets when the ratios make sense? That's what we're unpacking today, step by step. We were going to talk about what a top-tier macro investor said recently, the kind of statement that basically admits the quiet part out loud. We'll connect it to what bond markets are signaling right now, and then we'll hit the real question. If you're not selling into fiat, then what's the actual exit? What does taking profit look like? And how do you know when it's time? Yes, I'm going to give you a practical framework. Simple, memorable, and usable. So you're not operating on vibes, fear, or random headlines. One more quick thing before we hit the core. Check the description. I've left bonus links there, including access to our premium WhatsApp channel and an option to join channel membership if you want deeper research and want to support the work. Now, the mainstream financial world is great at disguising reality behind polished language. They don't say the system is wobbling. They say liquidity event. They don't say the debt can't be paid back. They say fiscal adjustment. They don't say people are losing faith in paper promises. They say risk-off rotation. But every so often, someone high up slips and says the truth in plain speech. That's what happened this week. A billionaire hedge fund named Smith, one of the most recognized on the planet, sat down at a major global gathering and basically said, the monetary order is breaking down. Not we're in a rough patch. Not a temporary issue. The order, the framework, the belief system. And when a person like that says it, you lean forward. That's not entertainment. That's a signal. Now, I'm not asking you to worship anybody. I don't care who said it. I care what it implies. It implies that central banks are shifting behavior, capital is moving differently, and old assumptions about safe assets are being questioned by the same people who used to sell those assumptions to you as truth. Here's the part I need you to hear clearly. Fiat currency is created as a liability. It's born out of debt. Every new unit has a matching IOU somewhere behind it. Gold doesn't have that shadow. Silver doesn't have that shadow. There's no counterparty that can default. No institution that can fail and take your purchasing power with it. No promise attached that can break. So when the system gets stressed, people don't run to more promises. They run to what exists. And it's not just regular people doing that. It's institutions. It's central banks. It's big money that has better data, better advisors, and better timing than you and me. So if that's happening, let me ask a question most people avoid. Why would you sell your lifeboat while the ship is still listing? Now I know what some of you are thinking. Okay, but everything has a price. There has to be a level where you sell. And this is where the answer surprises people who are still anchored to dollars, pounds, and euros. My approach is not sell gold and silver back into paper. My approach is exchange gold and silver for real assets when the ratios swing wildly in my favor. That's not semantics. That's strategy. Because selling for fiat assumes fiat is the destination. And if the monetary order is breaking down, fiat isn't the destination. Fiat is the bridge, or maybe the trap. So picture a different scoreboard. You're not measuring wealth by how many currency units you have. You're measuring wealth by what you can claim without needing a bank's permission. Land, productive equipment, a real business, inventory, a rental property, a farm, energy infrastructure, skills, even a stable home with no debt. And moving from metal into those assets isn't TI, about staring at a ticker and trying to nail the exact top. It's about watching ratios and watching behavior. Here's an analogy that sticks. We're on a monetary Titanic. Most people are still dancing because the music hasn't stopped. They're gambling because the lights are on. They're watching the stock market because the scoreboard still refreshes. But you can feel the vibration under the floor. You can see the water creeping in. You can sense the crew getting tense. Gold and silver are the lifeboats. Gold is the bigger lifeboat. Fewer people can afford it. It's compact, huge value in a small footprint. Silver is the crowded lifeboat. It's heavier and takes more space. But it's accessible to more people, and it has that everyday money history that matters when life gets weird. And here's the point. If you knew the ship was going down, you wouldn't throw your lifeboat overboard because someone offered you casino chips. So when do you sell? You exchange when the lifeboat buys you something better than safety, when it buys you control, stability, and long-term productivity. And that brings us to the framework. I use 3 filters. Filter 1, the system signal. If bond markets are breaking down, currencies are being diluted, and central banks are stacking gold, the system signal is flashing red. That's not the moment to reduce your insurance. That's the moment to be careful what you call profits. Because the biggest mistake during a monetary transition is selling real money early and loading into paper claims right before paper claims get repriced. Filter 2, the ratio signal. Stop asking, is gold high? Start asking, what does gold buy? How many ounces of gold buys a house where you live? How many ounces of silver buys a reliable vehicle? How many ounces of gold buys a diversified income-producing asset? When those ratios swing to historical extremes, when real assets become cheap in gold terms, that S when you begin exchanging. And most people will do the opposite. They'll buy the house when the house is expensive in gold terms because the dollar price feels normal. You won't. Not if you're listening to this. Filter 3, the personal signal. This is the part nobody talks about because it's not sexy. Your life matters. If you need liquidity for an emergency, if you're protecting your family, if you have a real business opportunity that produces cash flow, then yes, you may exchange a portion. The goal is not to die with perfect coins. The goal is to survive and thrive. Now let's tie this to what markets are doing, because this isn't theoretical. Bond markets are supposed to be the quiet corner of finance. Boring, stable. So when bonds start moving like meme stocks, that's not normal volatility. That's a warning flare. We recently saw long-term government bonds in a major economy get slammed and then bounce a little. Some people call that stability returning. I call it what traders call it, a bounce in a falling market, a breath before the next wave. Because the math is brutal. When total debt is enormous, higher rates don't just tighten conditions. They push servicing costs toward political impossibility. So what do policymakers do? They do what they always do, cap rates, print, or change the rules. And all 3 are bullish for hard assets over time, even if the ride is violent. Now add inflation, real inflation, not the polite version. We just saw consumer prices in the UK tick up again. Even if you accept the official numbers, here's the reality. Cash in the bank bleeds purchasing power, and most deposit rates don't truly compensate after taxes and real-world cost increases. That's the silent tax, the tax nobody votes on, the tax that punishes savers and rewards debtors. And once you see that clearly, you stop thinking about gold and silver as investments. You start thinking of them as stored time, stored labor, stored purchasing power you can redeem later when the world offers bargains. Now, I want to address a trap that kills people. Some of you are thinking, okay, but what about trading? Futures, options, timing tops? Listen, there's a place for speculation. But in a monetary reset environment, speculation is where people get shaken out. Paper markets can whip violently. Prices can dip. Headlines can scare you. Commentators can mock you. That's the point. They want you to dump the lifeboat because the chart turned red for 2 weeks. So if you're building real protection, separate your stack into 2 mental buckets. Bucket 1, core protection. Untouchable unless you're exchanging into a major life upgrade or a generational asset. Bucket 2, tactical. If you're skilled, you can rebalance, take partial gains, trade around volatility, but you never risk the core to win a tactical trade. Now here's why that macro investor comment matters even more when someone at that level hints that central banks are changing their relationship to fiat and debt. The next question is obvious. What are they holding instead? And the answer, backed by years of observable behavior, is gold. Not because it's trendy, not because it's a meme, because it's the settlement asset with no counterparty risk that survives empires, wars, and resets, so you don't have to copy them. But you should respect the direction of the flow. Now let's talk psychology, because this is where most people lose. Gold up, they feel smart. Gold down, they feel stupid. That emotional roller coaster is a fiat mindset. A real money mindset measures ounces, not paper price, because paper price is the stressed system's opinion. Ounces are reality in your hand. So when you ask, when do I sell? I'll say it again. I'm not dumping insurance because insurance got expensive. I'm holding until the world offers me an exchange that's too good to ignore. Let's make that concrete. Imagine a future where a solid piece of land can be acquired for 1 ounce of gold. Imagine productive farmland priced in ounces, not in constantly changing currency units. Imagine a world where building materials and labor are repriced, and people holding real money can build while everyone else is begging for loans. In that world, the decision isn't about hitting a price target. It's about converting stored purchasing power into productive ownership. That's the transition. And it probably won't happen in one move. It happens in waves. That's why you don't liquidate everything at once. You exchange in tranches as ratios become attractive. Quick side note. If you want to watch silver-related success stories, real people, real outcomes, there's a link in the description to a separate channel focused on that. Check it out. Back to the core. There's another indicator most people ignore because it's too simple. The Dow to gold ratio. Take the stock index and divide it by gold. When that ratio drops, it means gold is gaining ground versus stocks. Major regime shifts tend to show up there first, and if that ratio keeps compressing, it suggests capital is slowly rotating out of financial assets and into hard money. That matters because it hints at what the trade might be later. If gold becomes dramatically strong relative to stocks, there may come a point where exchanging gold into productive equities or real businesses becomes the trade of a generation. But not today. Not while the ship is still taking on water and policymakers are still doing verbal gymnastics to convince you it's fine. Now be careful. There's a trap on the other side too. Some people hear this and think it means never exchange. That's not what I'm saying. I'm saying don't exchange into weaker money. Exchange into stronger assets. Gold isn't the end goal, it's the bridge, and the end goal is control over your time, your stability, your family's future. Now let's hit silver for a minute. Silver is where emotions run hottest because it's faster and more volatile. Silver humbles traders. That's exactly why it can be so powerful in transitions. Because when silver moves, it can move in a way that shocks the public. And suddenly, the affordable lifeboat becomes scarce. So here's a question. When silver gets mainstream attention again, do you think the average person will be able to buy easily? Or will they show up late, find delays, find premiums, find empty shelves, and then blame everyone else? That's why you don't build your position during euphoria. You build before. Now, I want engagement. 2 questions. Answer them in the comments. First, when you think about metals, do you think in price targets, or do you think in what metals can buy? Second, if the monetary order really is shifting, what is the first real asset you'd want to exchange for? Land, a business, a home, equipment, something else? And while you were there, if you have had any financial win, paying off debt, building savings, starting a side income, share it. It lifts this community more than you think. Now bring it back to the theme. This isn't mainly gold is going up, its paper credibility is going down, and when credibility drops, capital demands higher yield, higher compensation, or it exits. That's what a capital war looks like. Not tanks, flows, not bombs, trust breaking. So if you're trying to time a top in gold while the world is renegotiating trust, you're playing the wrong game. The better game is holding what doesn't require trust and waiting for the world to offer you real things in exchange. Now here's a practical do this, not that, so nobody gets lost. Do this. Keep a core physical position you can access. Not that, don't leverage it, don't borrow against it to chase a trade. Do this. Track key ratios monthly. House to gold, stock to gold, land to gold, whatever matters in your world. Not that, don't stare at daily price ticks like it's a slot machine. Do this. Write a plan for what you want to acquire and what ratio makes you act. Not that, don't wait for the news to tell you it's safe. The news is always late. Reminder, description has bonus links, premium WhatsApp channel, and membership. We also do members-only videos with deeper research. If you want the full picture and want to support the work, consider joining. So where does that leave us? It leaves us in a world where gold and silver are protection first, not trades first. They're a vote against debasement, a way to step outside the promise-based system. And if you treat them that way, you are less likely to do what the system wants. Panic sell your protection during a manufactured scare. I'll close with one last thought. The thing most people still miss. Monetary systems don't break in a straight line. They break in phases. First, confidence erodes quietly. Then signals get weird. Bond volatility, currency weakness, sudden central bank shifts. Then authorities respond with solutions that create new distortions. And then, almost suddenly, the public realizes the rules changed. The question isn't whether that moment comes. The question is, will you be positioned before it's obvious? So, am I selling my gold and silver? Not into paper. I'm watching ratios, and I'm preparing to exchange into real assets when the opportunities are historic. If you want me to go deeper on specific ratios to watch, timing exchanges, and how to tailor this to your situation, tell me in the comments. I'll build the next video around what you actually need. And if this helped, subscribe. It matters more than you think. Drop Johan videos below so the algorithm knows this is worth pushing. And so I know you were part of the core community. Take care of yourselves. Take care of each other. I'll see you in the next one.